cap stocks. I think the implication is that banks are going to be a bit more reluctant to be lending to riskier clients. That itself could have an impact on slowing economic growth in the U.S. Our economists are not calling for a recession, but history overwhelmingly says that we are headed for recession. So I take the difference of the two and say it's likely to be fairly mild. When the Fed does pause, history says that they start to cut rates 9 months later, and that the S&P is up 13%, led by the financials up on average more than 22%. So I would tend to say that if the Fed pauses and stays paused, then I think investors are going to start moving back into equities.
Sam, I need to get to a couple of headlines. So we mentioned these headlines from Senator Warren. She's put out a statement. She's put out a tweet as well. Fed Chair Powell's actions directly contributed to these bank failures. I'd love for her to elaborate on that, and I'm sure many of you think that excuses what people think is otherwise a poorly ran institution. Vice Chair of Supervision, Barr, at the Federal Reserve, she says it's appropriate for the Vice Chair to have the independence necessary to do his job. Well, I imagine Senator Warren won't like what she's hearing once she sees what he's just said. Barr says, Tom, ultimately calls for more banking regulations, not the answer.
Yeah, this is different. There's many Barrs out there, John. There's Michael Barr, of course.
Oh, it's Andy Barr. Forgive me, Tom.
You know, I've made this mistake 3 or 4 times. I mean, you know, I did it at a Barrs. I got confused on Barrs. But there's Michael Barr, Bloomberg Sports. There is the vice chairman. And then there's Andy Barr that's going to take a Republican tone here. He does that over with Maria right now. And, you know, I think the idea that you're going to see the Republicans pushing back here as they did. And there is a immediate, John, and raging debate over how the Republicans, in which part of the Republicans, how they'll respond to this crisis.
Tom, thank you for the correction. That's really important. That was the Republican representative, Andy Barr, not the Vice Chair of Supervision. Thanks for that, TK. It's really important. I believe we've got to leave that interview there as well because the music's started, apparently, so thanks for that too. Coming up, we're going to catch up with a Republican, French Hill. Looking forward to that conversation in just a moment. Very different, TK. That conversation coming up shortly. Future's positive. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Chinese President Xi Jinping and Ukraine's Volodymyr Zelensky are said to be planning a video call in what would be their first conversation since Russia's invasion. The Wall Street Journal reported it could come after Xi visits Moscow, a trip which may happen next week. President Biden, meanwhile, says he expects to speak with China's leader soon once the government in Beijing returns to work following the National People's Congress. Credit Suisse CEO Ulrich Korner says the bank had seen inflows of client funds on Monday after markets and U.S. banks were pummeled by the collapse of Silicon Valley Bank.
So far, it's pretty calm. We even saw material good inflows yesterday still. Also, you know, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days to look at it.
Korner spoke exclusively with Bloomberg's Francine Lacqua. The U.S. system of federal home loan banks is ramping up the amount of cash it has available to deploy as a failure of several U.S. lenders sparks expectations that more regional lenders will need it to tap it for funds. The FHLB system, a key source of cash for regional lenders, raised $88.7 billion through the sale of short-term notes, exceeding the $64 billion that was initially planned. And Fannie Mae has postponed the sale of more than $500 million of mortgage-linked bonds sold by Nomura and Morgan Stanley. Bloomberg has learned Fannie Mae alerted investors that the deal, a $542 million credit risk transfer security, would be delayed, citing market conditions. Securities are riskier than regular Fannie Mae mortgage bonds because they're among the first to take losses when homeowners fail to make payments. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Is it important to you to have women in business? Are you trying to be a role model? And have you tried to be a role model for women in the business world?
Well, I think it's really important to have diverse voices at the table. And in business particularly, because, you know, most consumers are women also.
This is not a bailout of government taxpayer dollars. This is simply using fees that are assessed on all banks by the FDIC in such a time they would need them. So that money is there. It's not from the taxpayers.
That was Governor Kathy Hochul of New York. From New York, we are about 13, 14 minutes away from CPI in America. Equity futures shaping up as follows. Positive by 8 or 0.9%. Your bond market 359.22. Yields a bit higher on a 10-year, a whole lot higher on a 2-year after being aggressively lower the last couple of days. 2 years higher by 26 basis points. TK 424.
Credit Suisse nudging up, getting up in a recovery high. Thank you again to Francine Lacroix for that important interview with their leader in London at Queen Victoria Street. And FRC, John, nudging right up against it. It's pretty good tape right now for some of these stocks. They're doing better.
Doing better, I think, is the right way of putting it, Tom. Credit Suisse down by 1.4%, and First Republic, a bank we followed very closely the last couple of days with a decent lift as well.
We are thrilled to have the former banker of Little Rock with us right now. He is a name that will become very familiar to Americans here in the study of this financial blow-up. He is French Hill, Republican from Arkansas. French Hill, when you were at Vanderbilt, if you went down 40 and north on 265, you ended up where this debate began, at the Hermitage, at Andrew Jackson's spectacular home east of Nashville. And that's where this debate started, the raging debate over the second bank of the United States. The Republicans are Jacksonian. They're scared stiff of the big money of New York, et cetera, and the Democrats of the urban milieu push against that. How is this battle going to play out? Are we still in fear of the second bank of the United States?
Well, Tom, I love the history lesson, and the Hermitage is a beautiful spot. Andrew Jackson was a super controversial president. But today we're faced with a situation where I think after 10 years of easy money and amazing amounts of fiscal stimulus, I think some management teams have forgotten their prudential obligations to their depositors and their shareholders. So we have a real laxity in risk management in some of our financial institutions. And perhaps we've got laxity in the supervision of those institutions as well, particularly in the case of Silicon Valley.
Do we need to treat the banks such as Delphi that you ran in Arkansas? Do we need to treat smaller banks like the bigger banks out of Dodd-Frank? Do we need a one regulatory system? Is that the lesson learned?
Well, I think some of the costs of Dodd-Frank on small banks made them less competitive, harder to earn a return on invested capital there. And that's why Democrats and Republicans came together, as you noted earlier, and Barney Frank supported it to make modifications in Dodd-Frank's regulatory burden on small financial institutions. I don't think that in any way, shape, or form reduced the obligations of the bankers for their risk management legal requirements, or for the supervisors to do their routine job on a quarterly basis to make sure the system is safe and sound.
Congressman, you keep mentioning the supervision, and I'm wondering how much you fault Jerome Powell's Federal Reserve for the lack of supervision that you're talking about.
Well, the Silicon Valley Bank clearly had risk management problems in their strategy about short-term deposits that were uninsured, invested in long-term treasury and mortgage securities. And the California bank regulators, the state bank regulators, were the principal regulator, backed up by the San Francisco Bank of of the Fed. And so they do have a supervisory obligation. This bank grew very, very fast over the last 2 years, and that is usually a huge red flag to supervisors. And perhaps they could have intervened and helped the management team steer in a much more safe and sound direction.
Do you think that things have stabilized enough that you have confidence, given the intelligence that you've received, that the stability in the financial system is sound and that we're unlikely to see something else like this in the near future?
Well, you never know what's going to happen in the future, but we do have a safe and sound banking system with good capital and good earnings and generally good liquidity planning across the nation. I think that's clear over the past decade. But I think with low interest rates at zero and then a sharp increase in short rates, some management teams were not prepared for handling that in the right way. And so we may have bumps in the road as a result of that. And you've certainly seen that in the case of Silicon Valley last week.
Congressman, you've come on the show before and talked about how inflation is a tax on the poorest members of our society, about how when inflation gets this high, it becomes punitive for so many families. How important is it, from your vantage point, to see the ongoing rate hikes or some sort of continuation in monetary policy, regardless of some of the concerns that we've seen in the financial system? Or do you think that this is the clarion call that perhaps what we've seen is enough?
Lisa, it's a tough question. As I've said on your show before, that's the anguish of central banking, to try to balance these factors. But look, the Fed has a central obligation to all of us and our families of price stability. So they've got to have that as their principal mission, but they'll look at financial fragility as well. But I think the Fed should stay on track using their best judgment and looking at the data and make sure that they can beat this inflation and get it back down to closer to their target of 2%.
If we get to some new insurance regime, the belief here, Congressman, is the banks are going to pay for it, not the taxpayer. I get that idea. But is Arvest Bank of Bentonville, Arkansas, are they going to have to pick up the tab for the irresponsible behavior of West Coast technocrats?
Yeah, Tom, this is a great question. And, you know, back in 2008 and 2009, we moved to risk-based premiums based on the bank's CAMEL rating, their risk rating by the regulators. That was a step to making sure that people who run a poor shop pay a higher deposit insurance premium. Now the question is, should we have some sort of premium on top of this risk-based premium that would cover these sorts of situations where a bank is determined to be, like they did this weekend, systemically important, and yet we're insuring deposits for which no premium was paid. I think this is an important area for policy to consider. We looked at it back in 08 to 10. I think we need to look at it again in the face of this new banking system and Twitter runs, which is what was precipitating this collapse last week.
Let's meet in the rotunda. What is the common ground, Congressman Hill, of you and Senator Warren?
Well, I think both Senator Warren and I want a safe and sound banking system. We want to make sure, for example, in the digital asset space, that the rules of the road are clear and that we don't have this speculation that we've seen in that market and that criminals are prosecuted and fraudsters are prosecuted. But I would say to Senator Warren, look, we have a robust regulatory system with plenty of rules on banks of all sizes. What we need to see is vigorous supervision of those banks by their primary regulators at all stages of the economic cycle.
Does that mean, Congressman, walking back some of the deregulation we saw go through in 2018?
You know, Jonathan, I don't think so, because it was a very bipartisan, very modest tiering of the regulatory structure that came out of Dodd-Frank. I don't think you can lay I don't think you can lay the collapse of the banks last week at the foot of 2155. I just don't think that's relevant. I think what is relevant is risky management practices with or without Dodd-Frank and lack of supervision by the primary regulator.
The reason I ask that is because the regulator used the systemic risk exception to make depositors whole. And Congressman, what we've acknowledged over the weekend is that basically all banks in America carry some degree of systemic risk. So should they all be regulated in the same fashion regardless of size?
Well, I think tiering is important, but that gets back to Tom's good question about deposit insurance. Should we have a premium on top of the base risk-based premium that somehow reflects that systemic risk, and that would be something that somebody would have to think through analytically about how one would assess that in a fair and balanced way. But that speaks to this question, because you're right, the regulators this weekend determined that Silicon Valley's reach went well beyond its branches in California and New York as it related to the economy.
Congressman, always great to get your perspective. The banking system, the politics down in D.C. Congressman French Hill.
How odd. A politician with actual
Understands the
day-to-day
banking
skill.
I would say just because that
about.
bill in 2018 was bipartisan doesn't mean it was good. Just to be
that's his opinion.
about that.
Were we surprised?
Well, there's going to be a debate about that. Coming up in the next hour, we're going to run you through things with Chris Mamani, Kathy Jones, Erica Najarian on banks from UBS. Looking forward to that. Bob Dollar-Cross Mark as well. Michael Gapin of Bank of America. Big lineup in the next hour.
Lineup.
CPI coming up next. It's about 4 minutes away. Mike McKee's going to break down that for you. He's going to jump in a seat in just a moment. From New York, this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
The moment news breaks, no one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
Bloomberg Surveillance on radio and television across this nation, worldwide. Thank you so much for your comments over the last number of days. Lisa has read and looked at every single one of them. Into the inflation report we go.
Well, to me, this is really going to be an important moment. If inflation comes in hot,
unique.
What does Jay Powell do after what we've seen in the Great Reset of rate hike expectations?
Ignoring the financial crisis and completely focused on the inflation report, our Michael McKee.
Well, good morning. It looks like we won't need a potholder, Lisa. We come in, for the most part, on point, 0.4 gain in the CPI headline. However, there is a little bit of a worry and a 0.5% gain for the CPI core on the month. That is more than the 0.4 last month and the 0.4 that was expected. So a little bit higher in the core. It doesn't really make a difference on a year-over-year basis. Year-over-year falls to 5.5%. The core does from 5.6. The headline CPI matches expectations and comes in at 6%, down from 6.4%. So a little progress. We'll have to check and see what that extra tenth comes from in the core, but it does suggest, without looking at any of this, that maybe we are not seeing the big decline in rents that everybody was looking for.
Are we supposed to analyze this when the 2 years up 32 basis points to begin with?
But this is really, that's a great point. I'm looking right now at the 2-year yield. It's not moving that much. It's not moving on the news that on the margins, this was a hotter than expected core read, even though otherwise it came in bang in line. You are seeing still the NASDAQ pop even further. I mean, to me, I wonder how much people are looking past this, Mike, and saying this is all irrelevant because financial markets have changed. There has been a tighter condition. So this is all backward looking and doesn't really have an effect.
Well, it's kind of funny because 2 days ago, or let's say Thursday of last week, we would have said a number like this would have the Fed freaking out, and that 0.5% gain in the core would have people saying, oh, they should go 50. And now we're debating whether they're going to go nothing or 25. I think this, it doesn't really change the trend. Inflation is slowing, but it's not coming down very fast, and the Fed has more work to do. It is shelter, according to the Bureau of Labor Statistics, that really pushed everything up again this month. Right now, we're looking at a 0.8% gain in shelter, so that's up a tenth from the month before. Now that's the broader shelter number. I'll get you the breakdown on OER and rent, but that really didn't help at all. It looks like also we did see a bit of a gain in gasoline, which was expected by 1%, and used cars, which everybody watches, down 2.8%. So that's more than was thought.
Can you use services and goods now, or do you have to look at this while we grill Ethan Harris?
Well, I'm looking to see if we have the update on that yet, and it looks like we do.
Okay.
The core X housing is up is up 6.2%. That looks like it's not changed from the prior month. So
we'll let you dive
no change. Goods inflation drops to just 1%.
Okay,
so
well, that's part of
a
that
big
trend.
change there. 7%, another increase in services inflation, though.
We'll have to see there, Mike McKee, with that key trend for Chairman Powell and the rest of the Fed. Futures up 30. The VIX nicely in from that 30 level to 25.55. And those individual stocks we've been following through the morning. I can click here. I believe I can click here, Lisa, and get on FRC, if I could type correctly.
Yeah, you've seen an incredible rebound throughout the morning. Pac West.
Just a rebound, seeing if we're through 50 here. Well, we'll have to see on that. This is a joy. His name is Ethan Harris. He's an author. He's also head of global research at Bank of America Securities and stopped economics with a prescient book, Ben Bernanke's Fed, a few years ago. In that book, you talked about a theme I just talked to Vincent Reinhardt about, which was the shadow of Alan Greenspan. Are we in this mess, Dr. Harris, because we became unmeasured?
Well, I think that I don't think Alan Greenspan's legacy is really that strong right now. I think we got into this mess because, like a lot of central banks and a lot of economists, the Fed started to believe that inflation was largely dead and you didn't have to worry about a sloped Phillips curve, to put a technical term on it. And so they adopted a very passive monetary policy. Now we're seeing a massive catch-up by the Fed. And of course, financial accidents happen when you're hiking rates very fast. And so some of this is a legacy of the Feds and other central banks starting too slowly to deal with inflation.
The legacy and reality that I've seen within Brian Moynihan in his modern Bank of America is he's viscerally granular. Brian, more than any other CEO I know, has a granular feel. With all that research on your banking side, do you see a financial integrity to our banking system beneath the mass of Bank of America?
Well, I don't want to comment on Bank of America specifically.
No, I mean on the other banks and the other
I think
system that Moynihan's glued to. And
I think one of the questions for investors these days is how healthy is the banking system. And I think, as your previous guest said, the banking system overall is in excellent health. It's heavily regulated, heavily capitalized. You're always going to have, during periods of stress, some events. And I would think of this as, a stress event in the context of otherwise not just strong financial banking system, but strong financial system in general.
So when you look at the balance of risks right now, and this is something that I've been giving a lot of thought to, if the financial system is strong, you have these supports, you get a sense of a rebound, it doesn't really tighten financial conditions all that much from where we were. And in fact, given the lower expectations for Fed rate hikes, you have easier financial conditions than you did just a bit ago. At what point does that become a huge risk for inflation that does not come down?
Well, I think we need to recognize that we're in the middle of a stress event, and so it's very hard to predict where things are going. The markets will always price out the central bank during a crisis like this. But the real question is, does the policy efforts, does the attempt to ring-fence the problem, does it work? If it works, the Fed then goes back to their regularly scheduled program, and they have to deal with inflation. If it doesn't work, then monetary policy gets drawn into the process of supporting the financial system. Our view is that ultimately the ring fencing works and the Fed goes back to hiking interest rates. So I think our view would be that the markets understandably are in a very risk-off mode, but ultimately the Fed's going to end up having to fight inflation.
And this is the reason why you're in the camp of another 25 basis point rate hike next week. But I do wonder longer term whether the signs of stress have kind of gut checked your sense of how much these long and variable lags have come to the fore and put a higher, or rather a lower cap on how high rates can go.
Well, I think that unquestionably this stress in the system now tightens financial conditions and is a warning about the lagged effects of monetary policy. It's actually been surprising how little impact the Fed's had up to now. They hiked at a very fast pace. Now we're seeing some effects and perhaps an extreme effect. And so it does have to make you a little more cautious about how far the Fed needs to go.
Quickly, I've got to go to Mike, but let's get out in front of Michael Gapin in the next hour with John Farrell. He's a good economist. I mean,
he is. I think so.
Good. But let's get the Harris Gapin view here. Did they hike too rapidly? Were you guys sitting over the last number of weeks going that the rate of change, the Newtonian calculus of all this dance is just a little bit off?
No, I don't think so.
You weren't sitting there. Okay.
I think that the original error was waiting too long to hike. The gradualism of Greenspan, the idea you hike early so you can hike slowly, wasn't carried out. And it wasn't just the Fed.
That's what I said. The shadow of Greenspan here is
the shadow is that they didn't do it, Greenspan.
Okay. What we got to do is go to Michael McKee, who's diving into 47 pages of inflation data. Goods, you said, was 1%. Can you be joyous about a service disinflation?
No, unfortunately, services go up a little bit, 7.26%. But a lot of that, as we mentioned, is housing. Owner's equivalent rent up 0.7, same as it was last month. Rent of primary residence up 0.8. That's 1/10 more than it was in the month of January. But also, we got a big boost in the lodging category for shelter. It's up 2.3%. That's more than double what it was.
Lisa, are we shocked by that?
The month of January. Airfares were up, but here's an interesting thing, and I'd be interested to see if Ethan would go so far as to extrapolate the way I'm trying to here. But if you're looking at where you might be seeing wage increases, we've talked about leisure and hospitality a lot. Food away from home up 0.6 for the second month in a row, and full-service meals up 0.6. That's a tenth higher than it was. So prices are going up at restaurants. Alcoholic beverage prices went down. I'm not sure if that's not went down, but tailed off in inflation. I'm not sure as Tom helped with that.
But Mike, to that point, and Ethan, I'd love you to weigh in on this, because we have seen people willing to spend, and they're willing to spend on services, and that isn't diminishing. Does stress in the financial system really change that if people can get their deposits and everyone just goes on their way?
Well, if you can get past the panic moment here in the markets, which it is, you're back to an economy that's solid. It hasn't threatened a recession yet. As Mike pointed out, there's a lot of inflation in areas where labor costs are important. You can't fix your inflation problem just by getting an improvement in supply chains. You need to get the service side under control. You need a normal labor market, and we don't have a normal labor market.
Just quickly, I'd love your sense. Vincent Reinhart was on, and he said that if this Federal Reserve comes out and doesn't hike rates because of potential financial system stress, it is basically saying that what they did on Sunday was not effective, that program was not sufficient to stave off any distress. Do you agree? I mean, do you think that if they do not raise 25 basis points, that will be a policy error given the data we've seen?
I would never contradict Vince. He and I were grad students together. Anyways, no, I think that I think that it depends on how stressed the markets are. If the markets are in serious distress, pausing is okay. If they're improving a lot and the ring fencing is working, then you can start to wonder whether the Fed has confidence in its ring fencing. So I think that's a legitimate concern.
You and Vincent Reinhart with the laureate Ned Phelps.
Yeah.
His later career is dynamism. Do we risk losing our dynamism because of this crisis, and particularly the Silicon Valley crisis?
Well, I think that there's been the COVID crisis itself has taken some of the mojo out of the economy. I think that the tech sector, to some degree, is overexpanded. I think this is a temporary thing for tech. Tech is still going to be a driver of growth going forward.
Don't be a stranger.
All right.
Bring Mr. Moynihan with you next time. Dr. Harris is with the Bank of America. Lisa, I don't know what to make of the inflation report. I mean, we've got some market reaction, but there it is.
To me, what I make of it is the lack of market reaction. I thought that if it came out even slightly higher, people would reassess, you know, a little bit on the margins, but not much.
This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Emmanuel Macron faces parliamentary brinkmanship and protests this week over his plan to raise the retirement age. Wednesday, a group of 14 lawmakers from the National Assembly and Senate will meet behind closed doors to finalize a single bill to be presented for a vote in both houses. At the same time, unions will gather their forces for another day of strikes and protests against the proposed changes. The U.S. is urging Turkey to ratify the membership bids of Sweden and Finland into NATO as pressure builds on two remaining holdouts to approve the expansion of the military alliance. Officials from Turkey, Sweden, and Finland have been trying to break an impasse that has held up NATO's expansion since the two Nordic countries were invited to join in June. Now, Turkey, the only holdout besides Hungary, wants Sweden to crack down on groups Ankara considers terrorists in exchange for agreeing to a cession. President Biden plans to sign a new executive order intended to reduce gun violence. Biden will announce the move during a visit to the location of a mass shooting in Monterey Park, California. The president is evoking the limited authority of the executive branch to edge the country closer to universal firearms background checks, something that he's been unable to get through Congress, even though it remains popular in voter surveys. And a victory for Uber, Lyft, and other gig economy companies. A California appeals court has upheld the current law classifying gig workers as independent contractors instead of employees. The decision struck down a lower court ruling that found Proposition 22, the state measure that lets companies treat workers as independent contractors, violated California's Constitution. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
If the meeting were today, the Fed would be absolutely tone deaf to move rates higher. I don't think we should be questioning whether the tightening cycle is over yet. I think that's premature. But at least for the very near term, it would be hard to believe that a move higher in rates would be warranted right now.
Phil Camporiello, J.P. Morgan, thank you, Phil, for coming in today. There was the weather got in the way of that. We really appreciate his effort to get into our studio. Off the inflation report, many reporting, including Catherine Judge. She's at CIBC Toronto, and she says housing inflation a key driver. Lisa, you noticed that on the break.
70% of the increase. It's the single biggest contributor to the CPI gain. I'm also looking at what Mike was talking about, services side inflation coming in hotter than expected. You saw an upside surprise in the core reading on a month-over-month basis. You are seeing in the Fed rates market about a 5% Fed funds rate, terminal rate, being priced in now, which is marginally higher, but it's been whipsawed all over the place.
Yeah.
Next week, a very difficult one for Fed Chair Jay Powell.
Before we get to our good guests, Credit Suisse, of course, in Zurich, taming down here in their afternoon with a better appearance, price appearance, I should say, after their CEO spoke to our Francine Lacroix in London. Look for that out on Bloomberg Digital. And the FRC, which I don't really know all that much about, this troubled bank, from 148 down to 31, I believe, was the low. And that's an Abramowitz bounce this morning.
Yeah.
I mean, 31 to 50 gets it done.
Yeah, at one point it was up 65% now, but up 58% ahead of the market. You're seeing similar, although lesser, moves in PacWest, up almost 40% earlier this morning in pre-market trading.
Wow.
Again, off a very low base, still incredibly depressed relative to where it was, but stability, revival, perhaps bottom fishers, whatever you want to call it.
What people will do here is they'll look at the short-term market, the 3-month market, and there are other things. There's alphabet soup, FRAOISEIEIO. Old McDonald joins us now. Ira Jersey, our chief U.S. interest rate strategist for Bloomberg Intelligence. Ira, thank you for taking time out from writing your note this morning. What does the shortest of short-term paper, what does it say of our trust and confidence now?
But trust and confidence, I think people still, think that the U.S. is going to be money good. That being said, you look at some of those T-bills from August, and they're pricing in for a small chance of a default by the government due to the debt ceiling. But even regardless of that, just taking, the market moves the last couple of days, you can actually see how poor liquidity is, right? You don't get 50, 60 basis point moves, even with the significant, repricing of the Fed's terminal rate without liquidity being really drained.
Ira,
that's for sure.
Before you keep going, I want to just pick up on that. That's exactly where I wanted to go with you. You say liquidity is so poor, and yet we saw a 300% increase in trading volumes yesterday in treasuries, a massive spike in volatility, as you say. What do you mean when you say that there is a lack of liquidity?
Well, it's basically when you have the regulatory environment like it is, it's just hard for traditional intermediaries to increase the size of their balance sheet, whether they want to go long or short, and they're able to basically step in the middle of some of these large moves. And keep in mind that a lot of these moves, certainly the large rally we saw yesterday, a lot of that happened during European hours, right? Unsurprisingly, I guess, just given the news that came out over the weekend. So when you look at things like bid-offer spreads, naturally they're going to widen because of the amount of volatility. But more important is that you kind of have these air pockets where people just aren't willing to trade at every price necessarily, at least not in reasonably big size. And because the Treasury market now is over $20 trillion, and the size of some of the funding markets have basically remained the same over the last dozen years, you just have this mismatch of people able to lever up and take risk on a moment's notice than you did before. That's kind of the downside of prudential regulation. So the good thing is that you can have what happened over the weekend with SVB and Signature is depositors can be made whole because actually the regulations work the way they were intended. But on the other side, the downside of that is that the markets themselves wind up being somewhat more volatile than they might be otherwise, because you don't have the elasticity of balance sheets that you once had in the financial system.
I want to build on this because there's a question about when something breaks and people are looking to Silicon Valley Bank. But I wonder when we can take a look at some of the volatility, the biggest moves that we've seen going back more than 40 years, and say that's breaking too. That's positions being stopped out. That's exerting maximal pain over all market participants and becomes a self-fulfilling prophecy. At what point does that introduce an untenable risk for levered participants, for banks, for all sorts of entities that use these instruments, the deepest, most liquid market in the world, as a way to hedge all risk?
Yeah, so there are in the rates market, in my market, there's just an absolute plethora of instruments in the menu of different ways to hedge, right? Whether it's futures, options on futures, just outright options, over-the-counter swaps, right? So there's just a whole bunch of instruments used to hedge. The thing is that there's some investors, right, and some institutions that either aren't willing to pay for those hedges, maybe don't understand those hedges, and don't necessarily understand the risk that they have to take. Now, some of what's going on, I think, at the moment is some of the regulations worked as intended, but the unintended consequences of that are things like, holding a lot of mortgage-backed securities that are unhedged on your portfolio that are very underwater, right? That aren't trading near par. They're trading at 80 cents on the dollar, right? Some of them. And they have to hold those in order to meet some of the regulatory requirements. So that means that you have to be better at risk management than a lot of smaller institutions are able to be.
Ira, I want you to talk about the emotion of rates going up, and all of a sudden, and Lisa, you could tell me to the minute, you're so good at this, looking at BTMM, where a money market fund is a proxy, became 5.00%. And everybody at 4.99% was, yeah. And then boom, let's go. Did that shift of emotion to a new big handle change things? 5.00%. Did that shift the markets?
Well, I think not to 5% generally, but now you have an alternative to other lower yielding assets or assets with a lot of volatility, right? So, I've spoken to a lot of investors, multi-asset investors who can kind of go anywhere, right? Whether it's equities or FX or rates. And they're like, well, I'm buying 1 year bills now because at 5%, why not, right? Like it's not quite an equity-like return that we expect, but given the volatility of a lot of different markets, that doesn't seem, it seems like a reasonable place to park some money for a little while. while. So yeah, there's definitely the fact that you have an inverted curve and these yields that are not historically high, but high versus the last 15 years, just seems attractive to a lot of investors, and you are seeing some money flow that way for sure.
Ira Jersey, thank you so much. With Bloomberg Intelligence, look for his work out on the Bloomberg terminal with his team as well. Lisa, up a stick on the Dow, NASDAQ up a stick as well. VIX comes in 2 big points, 24.45. The VIX comes in 6 big points from the sweat of a few days ago.
I guess we avoided a massive upside surprise, which would have really perhaps given an aneurysm to some people on the central bank who'd have to deal with that, as well as financial stability risk. The MOVE index, the volatility gauge for bonds, still very high, still surging, and at the highest levels that we've seen going back to 2009. Of course, doesn't reset necessarily in real time. Just to go to what Ira Jersey was talking about, have we just experienced essentially a flash crash, a mini flash crash in the Treasury market in the wake of poor liquidity, less disintermediation by big banks, and a complete lack of conviction of where things are? What does that do longer term if you get these bouts of volatility in benchmark rates? And I'm talking about 6-month yields, for example, which hit 4.6% yesterday and are back up nearly to 5% today, 4.92%. Massive swings that you just see in these benchmark instruments.
To the comments of the president, the first order condition is to maintain trust and confidence in the banking system. And I thought that, among others, the banker French Hill of Arkansas laid out today clearly how unique the San Francisco, the Silicon Valley, the Santa Clara, whatever it is, experience was. And we seem to be getting beyond that. Maybe the most important headline today was knowing that Fortress Schwartzman is looking at whatever the debris is on their balance sheet. That was maybe the single most important headline today, whether it's true or not that Blackstone's coming in.
Well, Blackstone, Apollo, among those reported to have bid on some of these assets. Have we cleared the air? Have we avoided something more significant? The days will bear out, but it seems there is a moment of calm in a market that's reassessing the data.
It's like Huntley Brinkley, folks. It's Horton and Matthew. Balance of power tonight with the Secretary of Energy, Jennifer Granholm. An important conversation. Balance of power from Washington. Stay with us. This is Bloomberg.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. you know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
If you looked at CPI and payrolls and we didn't have a banking collapse, would the conversation this morning be, this Fed might be going 50? Except that's not the conversation, is it? S&P 500 futures up by more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, battered bank stocks looking to bounce, calls building for Chair Powell to hit pause as elevated inflation keeps the pressure on. We begin with the big issue. The market says the Fed is done. The latest data says it's not.
You got a little bit of whiff of financial instability.
The market is telling the Fed to be done.
Doesn't change the fact that we have inflation still above trend here, and that has to come down.
The market doesn't care that the inflation is still there.
This is a very, very difficult environment now.
The risk of something breaking is now tilting to be a little bit higher than the risk of runaway inflation.
The Federal Reserve is moving to slow inflation. That is going to have collateral damage along the way.
They put a pretty big bazooka in place with that BTFP program on Sunday. I think they're going to point to that.
It's very soon to make a call on the Fed being done.
US CPI could still be important.
It all depends on what the financial markets do this week.
The data would say you need to hike, and we've got financial stability risks pointing the other way.
Let's get straight into it with Lafayette's Krishna Mamani, Kathy Jones of Charles Schwab. To the two of you, thanks for being with us. We're about 29 minutes away from that open, with equities up more than 1%. Kathy, I know this is a difficult exercise, but go with me. If we could put the financial stability concerns to one side, and you looked at payrolls and you looked at CPI, would your base case be 50 for next week?
No, it'd be 25. I don't think that there's, even putting aside the financial instability issue, I don't think that there's a compelling case for the Fed to keep raising at 50 basis points a meeting. After all, we've already seen financial conditions tighten outside of what's happened over the past week or so. The senior loan officer survey has shown tightening credit conditions. We've seen a deceleration in inflation. Some good news on the wage growth side. That starts to ease. So I think 25 would have been my base case, even aside from everything that's happened.
Krishna, a lot's happened. Where are you on the Fed now, based on what we've heard so far?
Well, so I agree with Kathy. I think the likelihood of 50, even with this number, probably was modest. And this ensures, or the financial instability ensures, that it probably is not going to be 50 for sure. But for it not to be 25, I think that is a challenging case as well, especially based on the data and the fact that the Fed loses its optionality to tighten if things get worse down the road if they pause today. Because if they pause today, much the way that they are having difficulty ramping it back up to 50 from what they were doing earlier after cutting it down to 25, if they pause today, the likelihood that they can continue tightening, that optionality withers a little bit.
Well, Krishna, look at the calls to pause. Goldman Sachs, pause. Wells Fargo, pause. Barclays, they say pause. There is a whole host of banks now on Wall Street that say pause. NatWest, pause. Nomura goes one further. Take a listen to this. They say in reaction to looming financial stability risks, we now expect the Fed to cut rates, 25 basis points, beginning in March. We also expect the Fed to stop QT. What do you say back to that, Krishna?
Well, so I think there is a case to be made for pausing. Having said that, I think the Fed has to be mindful of the fact that inflation is still very, very high relative to what they're shooting for. And the underlying momentum in the economy is still quite strong. So it's not that the case for pause is zero. That's not the case. It's just that the preponderance of data is still pointing towards inflationary pressures, and the Fed has to have its eye on that particular issue. I think calling for a cut in this meeting is a little bit of a stretch for sure. That's more staking a position out rather than it being a realistic thing.
Well, we'll see in a week, and a week is a long time based on what we've seen over the last couple of days, that's for sure. Kathy, I got a message in the last hour. It said, I strongly believe they should hike based on the data. I don't trust them, though. Would you say back to that?
Well, I don't know about the trust thing. I think the problem is that the Fed has been all over the place with its messaging, so it's unclear what's important to them any given moment, and that I think is a problem. I do think that their commitment to fighting inflation is intact, but I also think financial stability trumps inflation fighting in the short run. And in order to hike at the next meeting, they're going to have to feel very confident that the financial stability issues have been resolved. The other thing I'd point out is, there's these long lag effects from tightening, and the market is telling the Fed quite clearly that it should be done. So with the tightening moves, and they're still doing QT. We have a steeply inverted yield curve. All of that would suggest to me that the market signaling is saying, hey, you've really done enough. The Fed is, though, trying to protect its kind of inflation-fighting credibility. So it's kind of a toss-up to me as to what they choose to do. But I don't think it's a matter of trust. I think it's a matter of perhaps not great communication on the part of the Fed.
Well, the market's screaming that they're done right now. On Wall Street, there's very little consensus when you listen to the economists, but the market, just looking at market pricing, which is just a way of aggregating all of this market is screaming they are done. Krishna, there is a psychological question I'd love your insight on. And it goes a little something like this. If they don't hike next week in response to incoming data, are they undermining what they announced Sunday evening? In other words, are they basically acknowledging that what they announced Sunday evening together with the Treasury and the FDIC is insufficient to insulate the financial system?
Well, I think, I don't think they will go down that path so easily. That is, I think they're likely to stick to the script that they have done enough, and if required for financial stability, they will do more in terms of providing liquidity to the banking system and do whatever that needs to be done. But I think Kathy's point is a good one, which is, yes, it is a toss-up, but even in that toss-up environment, if the economic momentum in the and the inflationary momentum in the economy is as elevated as it is, I think if they don't do anything, their credibility will be hit, and they're very, very, very aware of that, I'm pretty sure.
Just getting some headlines from Meta, from Facebook and Mark Zuckerberg. These headlines widely expected after the reports of the last week or so. Meta Platforms expecting to cut the team size by around 10,000 people, largely in line with expectations. There is an important line here, though. Meta to close around 5,000 additional open roles. That stock is positive by about 1.85%. They expect to announce layoffs in the business groups in late May, in tech groups in late April. Further cuts to the size of the recruiting team as well, as you might expect. So that stock's up by about 1.9%. That's not the focus of our attention this morning. Mike McKee, the focus of our attention is on you and the data so far going into the Fed next week.
Well, gee, I'm flattered. The data probably flatter the Fed a little bit here in the sense that they keep us on the same narrative that we were on before the banks started to go bad. And so it looks like maybe 25 is the way to go at this point, where you've got headline coming in as expected. The only real out of expectations number was the core monthly up 0.5% compared to 0.4%. And a lot of that comes from the service side, particularly housing up 0.7%, rent up 0.7%. That hasn't started to come down yet, and a lot of people are waiting for that. When it does, we should see a much more significant drop in inflation. The Powell indicator here does show some good news in one area, and that's goods and services inflation, but services ex core services ex housing comes down another 0.2 from 6.2 to just over 6, and that does suggest some pressure easing in that area, but services prices overall still going up, something the Fed's keeping an eye on. And if you take apart the numbers, you could see that there were increases in food away from home, especially at restaurants, does suggest that maybe there's some wage pressure in that area still. Where does it all leave us? Well, the latest Fed funds vote is that we're probably back on for a rate increase, the terminal index going up a little bit after the release of the Fed numbers. And John, of course, when you look at the bank stocks this morning in the pre-market trading, they're all up. The other good news is egg prices fell 7%. So it looks like that crisis is over too.
That's the news you need to know. Mike, thanks for that. As always, Mike McKee there, breaking things down for you. Let's break this down. Two-year yield in America, last Wednesday, north of 5%. Yesterday at the close, south of 4. This morning, up 31 basis points to 4.29. Now, Kathy, I'm sure you've had the conversation about what an inverted yield curve means with your clients, and often it means bad things. But equally, you've also got to explain why a bull steepener can also mean bad things. What do you make of the development that we've seen at the front end of the curve in the last couple of days, and what on earth does that signal?
Well, it's certainly been incredibly volatile, and I think that just reflects the combination of the liquidity considerations, the banking considerations, and the inflation and uncertainty about Fed policy. But yeah, the conversation we've been having is that as the curve begins to re-steepen or become less inverted, that usually is because we're headed into a recession. You know, that happens as you head into a slowdown in the economy, and the expectations are that short rates will come down and the whole curve comes down, but short rates come down faster than long rates. So it is another signal that, you know, perhaps the Fed is pretty close to being done. They may not be all the way done. We might get another 25. It seems like that's in the cards right now, but I think what we're seeing both in the economic indicators and the future leading indicators on inflation, this and the market action, it suggests to me that we're pretty close to being done in terms of Fed rate hikes, and that is a reflection of slowing economic growth on the horizon.
Typically, that's not a great time to buy equities. Krishna, last time we caught up with you, you said the pain trade was 4,500 on the S&P. Has that view changed, one? And two, what's the pain trade now?
Well, I think the biggest pain trade really was yesterday, which is people who were short rates in a big way, and they had to reposition. That certainly wasn't something that most of us were expecting ahead of the financial stability issues. I would say from an equity standpoint, the pain trade still very much is by the middle of the year, S&P 500 at 4,500. Again, most of us don't expect that. It is a pain trade for that very reason. Yeah. But I think if one can make a case that the outlook for a soft landing has actually improved rather than deteriorated because of this episode, because the Fed probably stops earlier, and credit growth, which would be one of the issues to kind of deal with, certainly would slow down as a result of this episode.
Hey, Krishna, stopping early because things are breaking. Is that bullish?
Well, things are breaking, but you know, things are breaking very modestly. I think people, when they compare this to 2008, clearly weren't there in 2008, because this isn't us talking about.
Krishna, can I jump in though? Forgive me, because we're up against the clock, and that's just the downside of TV. Let me just jump in. We always do this, and it drives me nuts. I get it. A lot of people that we talk to have been on the street for decades. I understand it. But when they say things like, it's not 1999 or 2000, or it's not 2008, I don't understand that. Why are we benchmarking to extremes to make the case that things are okay? It might not be 2000 in tech. It might not be 08 in banks. That doesn't mean it's okay, though. That just means it's not as extreme as those times. I don't think that's a good benchmark. Do you?
No, it isn't a good benchmark. But I think what you have to kind of factor in, along with all the issues that we are talking about, is the fact that the economy has substantial amount of momentum, and fiscal spending is still on the dock in terms of future spend. So the economic momentum is quite substantial. You know, it may not turn out the way we expect, but saying that the likelihood of that and things are breaking in a very, very big way, I think that would be an overstatement as well.
Krishna, always appreciate perspective. Thank you, sir. Krishna Mamani alongside Kathy Jones, two of the best on the street on fixed income and a whole lot more. Your equity market just about positive, nicely so actually, by more than 1%. With the latest on some stock moves, here's Katie Greifeld.
John, what a difference a day makes, at least when it comes to bank stocks. Let's start with KRE. That's your regional banks ETF. It's up double digits pre-market, up about 10% or so. First Republic, Western Alliance, some of your biggest gainers there. Both banks posted record drops yesterday, now up to the tune of 50% or so. Remember that they had been put on downgrade review, but clearly not a concern for the shares today.
Katie, thank you. Coming up, battered banks bouncing back.
When the Fed does pause, history says that they start to cut rates 9 months later, and that the S&P is up 13%, led by the financials up on average more than 22%.
The brilliant Erica Najarian of UBS up next.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.
President Biden defending the U.S. banking system after regulators stepped in to ease concerns of contagion. It wasn't enough to calm this market yesterday. First Republic ending the day down by more than 60%. Western Alliance by almost 50%. The regionals staging a comeback this morning at least after clocking record losses in the wake of SVB's collapse. Kaylee Lyons has more. Hey, Kaylee.
Hey, John, yeah, it seems like the markets are maybe buying more into the idea that these regulatory actions could stem the bleeding or contagion, at least for now, because you are seeing a pretty sizable rebound, almost to the extent that you saw a sizable selling pressure in yesterday's session taking place on this Tuesday morning. Right now, that regional banks ETF, KRE, is the ticker, up about 11% in pre-market trading, while the select financials ETF as a whole, so a wider view of the banking sector, is up by about 4%. Remember, those are pretty much comparable to the losses yesterday when that regional ETF was down about 12% in the Monday session. All that said, the rebound we are seeing today only goes so far to undo the pain we have seen over the course of several trading days, because between last Wednesday and the close yesterday, we have seen hundreds of billions of dollars wiped off the market value of bank shares globally. Just to take a few examples, Charles Schwab down nearly $45 billion in value over just the course of a few days. Bank of America, Wells Fargo, JP Morgan seeing tens of billions of dollars wiped out. And First Republic, $15.6 billion in market cap lost. It was a $22 billion company last Wednesday. So that is almost a very significant chunk of its market value. And actually, even though we are seeing this rebound today, it would need a 268% rally to reach its closing level from a week ago. The rebound today is coming despite the fact that we had Moody's putting First Republic and 5 other lenders put on review for a downgrade, citing concerns about deposits. But it seems like there is a buying of the dip here, John, and that may be due to momentum, considering these banks were deeply in oversold territory.
Katie, thank you. We'll come back to you in about 10 minutes, 11 minutes time around the opening bell. Erica Najarian of UBS has this to say on the regionals. The outlook is clear. They will be negatively impacted by what is likely to be higher costs to keep depositors, and later by tougher regulations. Suddenly, we think the industry could be hoping for rate cuts for deposit flow, cost and unrealized loss relief. Erica, I'm pleased to say, joins us right now. Erica, thanks for being with us. Can we just start with what was announced on Sunday? I think that's the right place to start. Do you think that was sufficient?
I do. So think about it this way, right? The Fed essentially could not resolve the sale of either Silicon Valley Bank or Signature over the weekend. And if they didn't introduce this facility, then you certainly would have had contagion risk, as everybody would start freaking out and put their deposits in the largest banks in the United States. I think this facility is actually quite brilliant because it allows banks that need it to tap into liquidity without crystallizing the unrealized losses on their bond portfolios. Keep in mind, one of the most important aspects of this facility is that the Fed is going to lend to the banks at the par value of their securities collateral.
Can we just build on that a little bit, Erica? You're best positioned to answer this, and I don't know the answer to it. Do some of these regional banks, though, have the right asset mix to access that facility? I understand this was set up in the wake of what happened with SVB, and clearly they did. I'm talking about what happened with treasuries, the duration mismatch, etc., mortgage-backed securities, all of the above. Erica, do you see the other banks having the right asset mix to access that facility?
Yes, so most U.S. banks have U.S. Treasuries or agency MBS in their securities portfolio. So that is the proper collateral mix to tap into that facility. Keep in mind that you can pledge muni bonds for those banks that have muni bonds against a discount window. So that's not necessarily closed to institutions that could have different collateral to post.
Is there a stigma attached, though, with going to the discount window?
Look, potentially, right? But I think that at the end of the day, we're not going to necessarily know who's tapped into either the new Fed facility or the discount window, potentially until earnings in April, right? And a lot can happen in terms of the markets calming down between now and then. And again, you know, you just talked about how the KRE is bouncing pretty heavily off of yesterday's lows. You know, sometimes the stock market could be its own mechanism for confidence. And if we have a recovery, right? And essentially, what if we have no more bad news in terms of bank seizures or failures by the end of the week, I think we could see confidence restore in the banking system, especially as Silicon Valley Bank deposit holders and Signature Bank deposit holders were both made whole.
Let's go to the major players. I think if a lot of people were thinking about moving banks over the weekend, they would have been thinking about moving to the SIBs, these big institutions, too big to fail, to make it very simple. Erica, do you see more reasons to buy them now as opposed to sell them?
Yes, absolutely. So, you know, keep in mind that these banking institutions already have the most stringent requirements on capital, and not just that, on liquidity, right? So those institutions, for example, have to hold $1 of liquidity for every dollar of excess cash, right? A non-operational deposit. So already they're under the most stringent rules. And of course, because they, you know, JP Morgan makes something like $140 billion of revenue, right? Their tech in terms of being able to provide, you know, treasury management, for example, for companies, you know, tends to be, you know, quite superior. And so, yes, I think they're the big winners in this. And I think at the end of the day, what the ironic part about this is, again, I heard you just a bit ago in terms of not comparing to the financial crisis.
Yeah.
Ironically, I think that institutional investors and retail investors will assign a higher multiple to large bank stocks, the old too big to fail camp, right? Because of the flight to quality and the perceived safety.
Not the first time we've heard that in the last 24 hours. Erica, thanks for being with us. Let's catch up soon. Erica Najarian there of UBS. Up next, your morning calls.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Minutes away from the opening bell, let's get you some morning calls. First up, Barclays upgrading Match Group, seeing limited downside due to improving margins. Wolf Research upgrading Roku, expecting a notable acceleration in subscribers. And finally, Deutsche Bank maintaining its buy rating on Schwab, saying the liquidity concerns are overblown. That stock's up by 14%. Up next, Crossmark's Bob Doll, expecting the S&P 500 to retest October lows. That conversation coming up. And we'll catch up with Mike Gapin of Bank of America. From New York, this is Bloomberg.
Did Art
conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there to kind of upside.
Good to see the good people of Strategas ring the opening bell at the NYSE. That's nice. Enough of that. Equity futures right now on the S&P up by about 1.4%. On the S&P 500. On the Nasdaq up by 1.25. Previous 3 days, 3-day losing streak on the S&P 500. And some monster moves in the bond market. That's the opening bell. Switch at the board and get to the bond market. 10-year yields higher by about a basis point. It's been all over the place. 358.84. Take a look at the front end of the curve, though. You've got to look at the 2-year over the last 4 days. Last Wednesday, north of 5%. Yesterday at the close, south of 4%. This morning, up 27 basis points. Your 2-year, 426. This came from Neil Dutter of Renaissance Macro a little bit earlier this morning, about 20 minutes ago. Said today's CPI inflation data make it clear that the effort to quell inflation is far from complete. Had it not been for SVB, the Fed would have likely moved 50 basis points in March. Instead, he still sees them going 25. Bear in mind, looking at euro-dollar at 107.30, there's still an ECB decision to come this week. The ECB were talking up 50, almost pre-committing to it. Dare I say they did pre-commit. Let's see what they do on Thursday, given this bank stuff. Elsewhere, looking at crude, down 2.4%, just about holding on to the 70s, 72, 73-ish. We're down about 2.5%. 50 seconds into this, we advanced by 1.3% on the S&P and the Nasdaq, up by 1.6. One sector to watch. It's the banks. Regional banks bouncing back after 6 days of losses, capping their longest losing streak in more than 5 months, with some major declines yesterday. Kelly Lyons has more. Hey, Kaylee.
Well, John, the gains this morning are almost as jaw-dropping as the losses of yesterday. Looking at the likes of First Republic right now up 58%. You have Western Alliance up 52%. PacWest also is up by more than 50%. So certainly a remarkable rebound, perhaps some buying of the dip here. I would just note that these banks have a lot farther to go to recover all of the losses seen over the course of the last week. First Republic would need to rally 268% in order to reach its closing level from a week ago. PacWest would need to jump 174%. Still, today is a start. We'll see if it sticks. Also, you are seeing a rally in some of those bigger banks, which at first were a bit insulated from some of these deep losses, but they were not immune to it yesterday. However, they too are participating in the rebound. We have the likes of Citi, Bank of America, Wells Fargo up in the tune between 5 and 7%. And according to Bloomberg's reporting, we also understand that these banks already are reaping the benefit of concern about a crisis in smaller banks. We know that JP Morgan has had billions of dollars in depositors coming in recent days, and the other banks are seeing higher than usual volume as well, according to people familiar with the matter who have spoken to Bloomberg. So that may just make too big to fail banks even bigger and maybe even continue their string of outperformance, given they are bigger and more diversified. That is what has helped lead the outperformance relative to regional banks, who are really the focus of concern when it comes to this duration gap and the mismatch between assets and liabilities and the vulnerability to the Fed's continued rate hikes.
Kelly Lyons. Kaylee, thank you. Maybe is perhaps the word we should be using for next week. Kelly, thank you very much. Kelly will stay close for the next 30 minutes as we work our way through some of this. Major bounce for you. Looking at United Airlines as well. United warning of a surprise loss this quarter amid higher labour costs. This coming after the company delivered an upbeat outlook back in January. Katie's back with us for more. Katie, what happened here?
It's obviously surprising if you look at the shares down about 5% or so. And you look at what analysts had been expecting. The average expectation among analysts were for a profit of 69 cents. Now the company disclosed in an SEC filing last night that it sees an adjusted loss between 60 cents and $1 in the first quarter. That is a wide range. And a lot of this, of course, comes back to labor costs and a potential deal with its pilot union. That is going to result in earlier expenses this quarter rather than next quarter. And we know that American, Delta, they're dealing with similar labor agreements, and that's weighing on profitability. Even though airlines are enjoying very strong demand, that is especially true for United. And disclosing this loss, they also said that operating revenue, it's going to be up 51% in the first quarter, and it posted record sales per average seat miles. But as we're all learning, John, sales do not equal profit necessarily.
Katie, thanks for that. That's the latest on United. Their stock is down by more than 6%. Meta, it's the year of efficiency. Meta's up by 4.6% in early trading. This is Facebook, of course. Mark Zuckerberg a little bit earlier announcing 10,000 job cuts, also closing around 5,000 additional open roles. Zuckerberg says this: over the next couple of months, organization leaders will announce restructuring plans focused on flattening our organizations, canceling lower priority projects, and reducing our hiring rates. So that's the latest from them. That stock is up by 4.5% from Facebook this morning. Let's turn to Credit Suisse. The shares rebounding a little bit. They were down hard over the last couple of days. They're up right now. The CEO seeing signs of confidence as the lender executes its turnaround plan.
So far, it's pretty calm. We even saw material good inflows yesterday still. Also, you know, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days to look at the...
Stock is up just about by 1%. Shanali has more. Hey, Shanali.
John, remember, they hit record lows before rebounding just a little bit. Credit Suisse is already trading at about 20% of its book value here when you take a look at it. But listen, they uttered some of the dirtier words in finance, which are material weaknesses when it comes to its reporting and controls. Now, we know that Credit Suisse has had a lot of issues when it comes to its controls. But again, we are watching them through this turnaround plan, so it is difficult for investors to keep watching them hit these roadblocks as they look to turn around. Now, the CEO did talk to Bloomberg earlier today. One positive sign is that yesterday, in a day of panic, they saw inflows. Now, they are still seeing broadly outflows, but those outflows are soaring. I think that CDS picture here is a really important story. We've been talking about it a lot, but just take a look at just how historic it's trading at. The widening of these credit spreads here, that tells a bigger story than the stock, I would say, which is already trading at historic lows. This here is the fear under the market when it comes to Credit Suisse. Globally important, systemically important bank. As we've been talking about, it has been trading at 20% of book value. But again, they are in the middle of a turning around story. So what is the story to start getting in? What is the story to buy? It will take years before that CSFP IPO starts to take wind. The CEO said that they are still searching for an investor, a large investor. They have not yet secured more money for that unit. So again, very much in the center of a turnaround story here with a drip of bad news today.
Will we see evidence of that turnaround, Shanali, by the time we get earnings? I think it's April 27th. And Shanali, given how quickly things move in this market these days, Shanali, for me, I don't know about you, but April 27th feels like a long way away.
It definitely is a long time away. And if you take a look at just the last week in the market alone, a lot can happen between now and then. Again, the idea here that they got inflows on a day like yesterday is an important part of the story because it's part of that story you've been hearing. Even Credit Suisse, you're seeing systemically important banks be an important part of the story because we have a big existential question here about the meaning of a government backstop.
It was a great conversation with Francine. Enjoyed the interview on Bloomberg Surveillance. And to those of you that missed it, please rewatch it. It wasn't clear whether that was net inflows, though, Shanali. Did that stand out for you?
It did, but the idea here, remember, this is a person here. Remember, Credit Suisse has recently got in trouble from regulators because of potentially misleading statements. So you have to understand here that when the executives are speaking, they're speaking with a heck of a lot of caution while they're trying to clamp down here on a lot of negative energy behind the stock.
A much-needed bounce, although I don't know if you can call this a bounce. We're up by 1%, 228 and Credit Suisse. Shanali, great work as always. Bob Dollar Crossmark, questioning the Fed's higher for longer narrative after the SVB's fallout, says this: credit and liquidity events cause uncertainty and hesitation. This will slow the economy and accomplish some of the Fed's work for them. Bob Dole joins us right now. Bob, let's take it easy. I just need to take a breath for a moment. What a couple of days. Bob Dole, what do you make of what you've seen?
Unbelievable. I mean, to think that the 2-year down 100 basis points in a few days, up 25, it's like a volatile growth stock. It's incredible what's going on.
Do you like the banks right now, Bob? Because I know there's been a sell-off. Some people think it's an opportunity. I want to be very clear about where they think that opportunity is. Some people think it's in the big names. This came from Marko Kolanovic at JP Morgan. He said, we believe the sell-off in large cap banks was overdone, as they have a lot more liquidity than smaller banks. They are more diversified with broader business models, have a lot of capital, are much better managed with regard to risk rather, and have a lot of oversight from regulators. Do you like what you see there, Bob?
Yeah, I think the financials and the banks in particular are one of the cheapest sectors in the market. Obviously, there are a lot of cross currents here, but their balance sheets are in much better shape than they were at any time before prior recessions. So I'm of the view that, especially on weakness, I did a little nibbling on Friday, a little more tomorrow. On a big up day, I'm unlikely to buy some more, but on pullbacks, I would add to the banks.
But these are the large cap banks, to be clear, Bob. That's what you've been buying?
Yes, sir.
Okay, what about outside of that? Because yesterday you saw in the session a clear distinction between the financials underperforming, quite rate-sensitive story at the top of the pile, the usual move as you might expect, real estate, utilities, tech. Anything you've liked there in the rally you have seen in that part of the market?
So as the economy slows, because the Fed's raised rates from 0 to 4.5 in a year, and probably gives us a mild recession, this return to growth is probably going to last a bit longer, as people say, I think I can own some stocks that are less dependent on the overall economy, and that's why you're seeing this run in the growth stocks to include some of the big tech stocks.
So, Bob, how challenged is your view that we retest the October low, given what you just said?
I think we will. Look, every time we have an interest rate hike of this kind of magnitude, there's a bump in the night. We saw it over the weekend with the bank stocks. What's yet to be felt is the slowdown in the economy. Monetary policy, Fed action, operates on the economy with long and unpredictable lags. The bump in the night was, I think, the first warning crack. The economy will slow as well. And in fact, the bank issue, as you read the quote of mine, will in fact slow the economy some more. So I think earnings are at risk. That's what we need to focus on.
So, Bob, we need to talk about earnings. We need to talk about Fed policy. Dan Iverson at PIMCO said this could be a multi-month process. He spoke to our team here at Bloomberg. Always fantastic to hear from him. There has been a meaningful tightening of financial conditions and significant risk aversion that we don't think is over. Bob, that speaks to what you've said. He said this is likely a multi-month adjustment process. It's possible that the Fed pauses in March, and we do think there will be more reverberations around the banking sector. Now, Bob, let's put two competing forces together. If we are going to see tighter financial conditions off the back of this stress in the financial system, at the same time, if the Fed does pause and back away, net-net, is that good or bad for stocks?
It's not good. Look, I think what the Fed has already done is more important than what the Fed might do at their next meeting or the next couple of meetings. They may do nothing. They may raise once. I doubt they'll raise 2 more times. That's not important compared to the impact of what the Fed has already done that we've yet to feel, and that will slow the economy.
So where do you think the biggest earnings challenge might be in this equity market?
I think mostly across the board, as people are expecting, the recession word had basically left the vocabulary of Wall Street. Soft landing, no landing was the popular item. I think with this bank issue, we're going to see that word coming back in and earnings will come down. Obviously, the more cyclically oriented an area is, the more likely the earnings are at risk.
So, Bob, there are two camps. I talked about it yesterday. One camp truly believes that you can isolate the banking story. The Fed and regulators have the tools to address it, and the Federal Reserve can carry on focusing monetary policy on the inflation issue. Are you saying the former should shape the latter?
To some degree, yes. I like the fact that there were facilities put in place, particularly the ability to go borrow at par. That really puts a safety net on the things, and so we can park that to the side to some degree and then worry about inflation on the other. But I repeat, the actions of the financial sector and the overall pall that creates for consumers and businesses does a lot of the work for the Fed. I think what happened the last week is 100 basis points worth of tightening in the Fed. That will be the impact.
Wow. Bob Dole across Smart with a big call. Bob, thank you. Some people share that view. Seen some real tightening in parts of the credit market. Elsewhere, I'm looking at the S&P 500 up by 1.6%, the Nasdaq up by almost 2 full percentage points. And if I told you that payrolls would come in at 311, that you'd see inflation come in where it came in this morning, which was basically at 0.5% on core relative to the 0.4 expected a week ago after Powell spoke. There were people lining up to tell us on this program that meant a 50 basis point hike from this Federal Reserve. And then, of course, the banking issue seems to have changed a lot for a lot of people. Coming up on this program, inflation, keeping the pressure on the Biden administration.
We're expecting to see inflation ease over the year. There may be bumps along the way, however. We know that we can't focus on any one month.
Mike Gapen of Bank of America up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We understand that inflation needs to come down. It's why it's the president's highest priority. We're expecting to see inflation ease over the year. There may be bumps along the way, however. We know that we can't focus on any one month, but that is what most forecasters are expecting.
Well, there's some bumps right now. Today's CPI print keeping the pressure on the Biden administration to tame inflation. The White House expecting inflation to cool over the next year and into next year as well. AMH down in D.C. joins us now for more. Hey, Anne-Marie.
Hey, John, we heard from Celia Rouse there. Obviously, the president's new NEC director, Lael Brainerd, these individuals are going to be looking at what the economists look at, which is core CPI, which we did see pick up some space, especially that gauge that the Fed Chair Jay Powell looks at, core CPI, excluding shelter. That remains stubbornly high. These are the bumps in the road that the Biden administration is going to be looking at behind the scenes. But when the president comes out and if he talks about inflation or if there is a statement, they're going to point to annual inflation. And that came in at 6%. It's the lowest since September of 2021. So the message from this White House is going to be there is still a lot we need to do. Inflation is far too high, but potentially they will try to say they are seeing some progress.
Anne-Marie used to join us at 10 past the hour, and then she got a new show, so it's been pushed back to like 9:50. AMH,
I was
thank
still here for you.
Sure, down in Washington, appreciate it. Looking out to that program a little bit later, looking forward to it with Anne-Marie and Joe Matthew on Bloomberg TV and Bloomberg Radio. Sound on, 5 p.m. Eastern Time. B of A's Mike Gapin has this to say. We retain our outlook for monetary policy, a 25 basis point hike in March, terminal 525 to 550, ongoing balance sheet runoff. Mike Gapin, you wrote that before the CPI print. Have you edited it at all?
No, I haven't. We just think if the Fed, as you mentioned in your previous segment, if they're successful in kind of ring fencing and containing the financial stress for the moment, the broader macro environment, whether it's jobs, inflation, activity, consumer spending, still supports higher policy rates. So we think the Fed's inclined to keep that on track next week, and we look for them to lift the policy rate by 25 basis points and continue with balance sheet runoff. Obviously, that's day to day right now, dependent on market events, but that was our view yesterday. It's our view today.
Mike, why don't you think this SVB issue screams you're breaking stuff, you've done enough, we're sufficiently restrictive?
Well, I certainly think it is a signal that financial conditions have tightened. There was a building narrative that the U.S. economy was impervious or immune to higher interest rates, and certainly parts of the economy are resilient to it, and consumer spending has maintained a lot of momentum. But there's other parts in the economy, housing, business spending, manufacturing output, and certainly, what we're seeing now with potential spillover into lending conditions that do reflect the tightening in financial conditions from the Fed. So I think it does tell you policy is restrictive, and we'll find out where exactly sufficiently restrictive is. I do think higher policy rates are warranted, but yes, the events in recent days do tell us Fed policy matters, and when you raise rates this fast, you sometimes get these financial stress events, and we're getting one right now.
Well, the banks are rallying today. I've got no idea what they do tomorrow, day after that. I've got no idea where we'll be next week. But the here and now, Matt Lazzetti at Deutsche Bank, Mike, you might have seen this, you might not have. He's aggressively revised his terminal rate, his forecast from 5.625% down to 5.125%. Would you be thinking about doing the same thing, given that you're not too far away from that level either?
Yeah, entirely possible. We don't, as you were, I think, are alluding to, we don't exactly know where sufficiently restrictive is. We're still in the 525 to 550 camp, but yes, I think we're meeting by meeting here. We're week by week. And as the data evolve, we'll get a better idea of, is it something closer to 6? Is it something closer to 5? So that's completely reasonable. And our visibility here, I think we should be a little humble in how far out we can look right now. So it's a reasonable outlook. I think they can go a little higher, but we're not that far apart.
Given the moves in the bond market, Mike, I'm with you. I can't get past today, never mind next week and months or two. Year end, if anyone's trying to forecast that. Mike, something came up today, and I'd love your response to it. I know we can tie ourselves in knots thinking too deeply about all this stuff, but just the psychological story that this Fed has to confront on the FOMC next week. It was suggested to me this morning by two people, Priya Misra, TD, Vincent Reinhart, Dreyfus and Mellon, who suggested there was a psychological element to this, that if the Federal Reserve didn't continue hiking, there was some kind of acknowledgement that what they had announced on Sunday wasn't sufficient, and therefore they had to back away on monetary policy. Is there anything in that for you?
I would say a little. I think in defense of the Fed, the fact that these two things are happening so close together, the stress event and the meeting, makes it hard, I think, if they don't hike, to say, oh, then the ring fencing isn't sufficient. I mean, they just stood up these systemic risk tools on Sunday night, and today's Tuesday. So if they had to pause in March, they could certainly do that, and I don't think it would be an indictment of the tools that they've put into place. If there were more space between the event and the meeting, there'd be more time for things to cool down. But the bigger principle, the Fed can chew gum and walk at the same time. It can use its lender of last resort tools to quell financial market, stress, and it can also keep its broader eye on the macro economy. So the Fed's trying to do that, walk and chew gum right now. We'll see if they can. I think they can do it.
Mike, I've got to squeeze this in. We've got 30 seconds left. If Chairman Powell had day one of testimony in front of the Senate today, like he did this time last week, how different would that address have been?
Probably not so much focused on returning to a faster pace, but yes, a more kind of balanced assessment of dealing with stresses on one side, but still needing tighter monetary conditions on the other. And I do think it supports just, moderate rate increases until we figure out what the right rate is. So I think 25 makes sense for now.
We've got a ton to figure out. Mike Apen of BofA. Mike, thank you. As always, great work. Looking at your session right now, 23 minutes in, equities advanced 1.5%, outperforming.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
This is Bloomberg.
So far, so good. Let's see if it sticks. KBW Bank Index, best day of the year so far. If the session closed here, of course, the session's not closing anytime soon. Your equity market up by 1.4% on the S&P. The financials lead. That's the price action. Here's the trading diary. Coming up, US PPI, retail sales tomorrow morning. Housing starts, another round of claims on Thursday, plus an ECB decision and news conference with President Lagarde, Secretary Yellen heading to Capitol Hill, and finally closing out the week with UMich Consumer Sentiment Survey on Friday. From New York, that does it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to
combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers. One of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as you described about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, we say, I'm a Swero and I aim to be a doctor. I am a Swero. I aim to be a top-notch engineer. I am a Swero. I aim to be a top bureaucrat of this country. I'm a Swero. I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny,